Back. My name is Chris Saginelli. I get to build, buy, and sell simple profit businesses every single day. And today we're going to be taking the concept of private equity and hopefully explaining something that tends to be a little bit complicated or complex in a super simple story. And we're going to use a character that my daughter helped us create in the book on bootstrapping, whose name is Sally Sue, right? And Sally Sue owns a lemonade stand, and we're going to take her journey building her lemonade stand. We're actually going to share behind the curtain, what private equity even is, how it works, and how you can leverage some of these lessons in your favor as you're building a profit-led or a simple profitable business. Right. So first and foremost, before we get started, what is private equity? And in the most basic of sense, it's really just an investment in a privately held company. Right. So when you're investing or owning a company that is not listed or publicly traded, you're in private equity. And a lot of us as business owners think that private equity is this complicated or complex or maybe a black box term that, somebody who's a puppet master pulling some strings somewhere is moving the universe with. But the reality is most of us, if you're a business owner, you're already in private equity, right? Your business is by every sense that you own a part of your private equity portfolio. So I want to change this perspective so that we can change our approach and hopefully simplify some things that feel complicated. And in that simplification, you'll put us in a position, an empowered position to take advantage of the way the market works. Because when you start to learn how the market works, you can start to work it in your favor. So this is Sally Sue. And Sally Sue is an entrepreneur who owns a lemonade stand. It's Sally Sue's lemonade stand, right? And just like every business, it starts with a concept, and there's no different when we're talking about doing a private equity deal, right? So Sally Sue wanted to start her lemonade stand. She went out, she researched the market, she made sure that there was a demand for lemonade in her neighborhood. She put together a really simple plan so that she could get things together in terms of what her goals are as a North Star and the products that she's going to be selling and who her ICP is, like what customers she's targeting and the pricing behind it, so that she could organize around profits and get her funding together initially so that she could get the right resources and materials to be able to put together her stand and actually start selling some lemonade. So she did that, and then she actually set up her business. She named it Sally Sue's Lemonade Stand. She picked her location. She went through all of the hurdles that are in front of her in terms of permits, to be able to form her business and actually start selling her first cup of lemonade. But she did it. So she's in production, right? And she's using the most fresh and awesome, materials in terms of these refreshing lemons that she's squeezing and adding the sugar and the water into. She mixes everything together every single day, and she keeps it cool with the ice, and she starts acquiring customers. So Sally Sue starts to sell her lemonade stand. She's selling it, using a simple sign to get customer attention. Lemonade, 50 cents a glass. She tells all of her friends and her neighbors, and she said, hey, come try some free samples, right? This is the best lemonade. And whenever a customer comes into her door, into her stand, she greets them. She has a smile. She's a really pleasant person, and she takes pride in every single glass that she serves, right? And if somebody doesn't have the money at the time, for that cup, that big cup that she wants, you know what she'll do? She'll offer them a smaller cup, or she'll, give it to them on credit or a discount, because she really appreciates her customer. She enjoys her customer. She always puts her customer first, and she listens to them. And because of that, the revenue starts to flow, and eventually the profit starts to come into her pocket, right? Because she understands what her revenue is, what she's pricing it out, what the costs are in terms of everything going into landing, selling, producing and selling that cup of lemonade, and then the profit at the end of the day that she gets to put into her profit pocket. And because she's so passionate about what she does, she really takes pride in terms of managing everything. And she gets to operational excellence, right? She keeps good track of her inventory. She makes sure that there's quality controls in place. And she, at the end of the day, just needs to focus on mitigating risk, because if she can take the risk off the table, then ultimately she's left with the upside reward. And by doing that consistently every single day, just show up, trust the process, commit to the journey, Sally Sue's Lemonade is growing. It's a thriving private business. Right? She owns it. But now she wants to assess her options in terms of how she can maybe add some new cups of or types of lemonade to the market, right? Because she listened to her customers and they said that maybe she should do strawberry lemonade or a mint lemonade. And she's thinking about maybe hiring a friend because right now she's an exit one business and she's doing all the work, right? She exited out of her day job, made the lemonade stand her primary focus, but she doesn't want to do everything. So she wants to exit out of doing the work and start building a team, exit two. And she's realizing that maybe at some point she's going to get her operational efficiency so great, she needs to start to set up multiple stands to be able to expand. And she's going to start to hire some operators, right? Once she has her business system in place, exit 3 business, exit 4 business. And she needs that funding. And she knows that her route is either debt or equity, because as small businesses, right, we typically we have options, and typically there's 2 paths that we typically need to be able to travel in a traditional capital sense for funding, and that's either debt capital, where you're borrowing money, or equity capital, where you're selling ownership of the business, right? So she's going to explore this debt capital approach first, where she's handing over a promissory note in her stand to this potential investor. And when we're talking about debt capital, there's no change in ownership, right? So there's no stake of the business that's going to the owner. The repayments are typically, a structured repayment of principal and interest that's paid back over a very specific period of time. The control of the business doesn't change hands, right? Sally Sue is still going to remain in control. In terms of risk, though, the risk starts to increase with debt capital for Sally Sue, because now she needs to make these capital payments. She needs to be able to service her debt, which are fixed repayment obligations. And sometimes that could really crush her cash flow, especially if maybe she sees a dip in the market. Maybe the weather gets a little bit cold and demand for her lemonade goes down, right? From a collateral's perspective, it's oftentimes going to require her to sign over some sort of personal guarantee, or she's going to put up her assets in the stands as collateral. And it can ultimately have some sort of impact on her and her personal credit for borrowing against the business. And there's some risk that she could be left with, losing things if things were to go south, or if she was to miss a payment, right? The other option she has is to, take on equity capital. And equity capital is, what people typically think about when, you think about raising money from investors, right? So in Sally Sue taking on equity, she's selling shares of lemonade of Sally Sue Lemonade Stand company, right? So in ownership, there is going to be dilution, right? Because now investors are coming in. Sally Sue is going to own a smaller piece of Sally Sue Lemonade Stand. She's going to be sharing a piece of that pie with her investors. Now, that makes sense when the pie is getting bigger and bigger and bigger, and there's a justification for it, right? But if, traditional small business, that pie is not necessarily getting bigger. It doesn't always, make sense to give up a piece of a not so much growing pie, right? If you're building the Uber for X, or if you're, what traditionally a venture-backed startup with a moonshot market where you could grow really fast, that could make a ton of sense. Now, from a repayment positioning, she doesn't have to worry about having to make these fixed repayments for her business, right? So if revenue was to dip, she's not coming out of pocket, and she doesn't feel that cash flow crunch of debt, right? Of a heavy loan payment, right? However, from a control perspective, she may end up giving up control. She may end up losing control to her investors, depending upon the preferences that are being put in to the shares when she's signing over the ownership of that equity. Right? There may be dividends tied to this, where there may be profits coming out of the company and going into the pockets of the investors, if there's dividends at play. But from a risk perspective, it's typically a little bit less risk than traditional debt capital, especially for Sally Sue, who's building Sally Sue's Lemonade Stand, right? the investors are in it with her. Everybody's in the boat together when it comes to equity. And she didn't have to put up that collateral that she needed to. Maybe it was her personal guarantee of maybe her home or her car, or, whatever the case is, or the lemonade stands themselves, asset backed, right? Sally Sue didn't have to deal with that because these are equity investors. However, she did have to deal with dilution. So she definitely owns less of the business today than she did before. And that may or may not be okay with her, right? So Sally Sue has to make a decision for her business of which of these two routes she wants to travel. And they're different types of routes for different types of businesses. And that's something that we really want to, be able to emphasize as folks are making a good timely decision for their own business, because there's ramifications. And depending upon the type of vehicle you're in, there's a different road that you should travel, right? So Sally Sue's going to make this decision, but there's always another side of the table. So whether it's debt or whether it's equity, there's somebody putting up cash. And that person that's putting up cash is an investor. And that's a private equity investor. They're investing in a private business, right? Just as Sally Sue is too. And this is something that we want to emphasize and really underline here is Sally Sue herself is an investpreneur, right? She's investing in herself. She is her own first investor. She's investing in Sally Sue's lemonade stand from the very beginning, taking on the most risk. She's an investpreneur. She's a private equity investor, right, in her business. And hopefully as she continues to grow, maybe others too. She may get into merger and acquisition, M&A activity, and start to buy out other businesses. Who knows? But first, she needs to get past this first hurdle, which is getting outside capital. And when this investor is looking at Sally Sue's lemonade stand, what they're really trying to do is understand the risk inside of the business, right? Because investors are looking to mitigate risk, and something that's really important. Risk is something that dramatically can impact the valuation or the cost of capital. And the job to be done when we're trying to build affordable capital and we're trying to get higher valuations, better terms on investment, larger exit multiples, is to reduce as much risk as we possibly can for the investors. And that risk could be financial risk. It could be operational risk. It could be process-based risk. It could be human capital-based risk, right? All of that at the end of the day are going to be drivers that impact the valuation of the business. And when it comes to the investor, they're looking at all of these things. And on this sheet of paper, there's only a few dozen drivers. But in reality, for us over at Bootstrapper Capital, we look at hundreds of different value drivers that all impact the risk of a business. And the funny thing about risk is the inversion of risk is returns, right? So if you look at this chart here, when you're looking at it on the right side here, this says less risk, higher returns. And that's very much so true, because if you're going to the curve, the production curve of the business, and you go to risk and you reduce the risk, right? And now you follow it up on the returns, you're going to see higher returns, lower risk, higher returns. And this triangle in the middle that's getting built, I wrote here wedge because that's what it is. It's wedge equity being built. That is equity that can be built in a business because you're focused on risk reduction in that business. And systematically over time, what that allows you to do is remove risk to build equity. And we call it mastering the 5 exits of ownership because it's something that has to take place over time, right? We look at every business as a start and every business as a finish, and every business ultimately exits, right? We're all always exiting, whether it's an exit that we want and we sell, or it's an exit that we don't want and we go out of business, like 50% of small businesses in America do within their first 5 years. Most businesses fail. 50%, over 50% will fail within the first 5 years. 2/3 of businesses, small businesses, will fail within the first 10 years. And if you're a venture-backed startup and you want that equity route, the odds are even more so against you. And it's even higher in terms of a failure rate, right? So what we focus on is promoting folks to master the 5 exits of ownership, building sustainable businesses over time that mature through each of the exits of ownership. from starting, where you're exiting your day job and you're making the business your job, all the way through to exit 5, where you're actually selling the business. And then every exit in the middle, which allows you to build equity as you systematically improve the business and grow the business to take away risk, right? So while you're growing, you're removing risk. And because you're removing risk, you're increasing the equitable value of the business, right? You're making yourself more investable. Getting exit ready is also how a business can get capital ready, which is kind of funny the way that works, right? Funny thing about capital, it tends to go to the places or the people that don't really need it. So the best way to get ready to raise money is to make sure you don't need money today, right? Be proactive in that process. For us, we developed the equity management system. We did that for ourselves. We did it for our portfolio businesses. And we also provide it to any business that we actively want to do a deal with or invest in over at Bootstrapper Capital, because it's a proven way for us to reduce risk systematically. We do it in a very systematic, process-led approach to get profit-led, right? Because we focus on profit-led businesses. And the very first step is to organize around profit. We then standardize around product. We then simplify around process, and then we optimize around people. And what this allows us to do is improve profitability. It allows us to get into a situation to be able to reinvest into the business, build a stronger brand, expand the market presence, develop true intellectual property, grow and diversify the customer base, strengthen the actual business system and the standard operating procedures and the operations, to reduce the dependency on any key individual, to actually build out the flows of revenue, the number, the quantity and quality of revenue streams, and diversification of the customer portfolio, reducing risk, improving the ability to pay off debt, and serve as additional capital in the future for expansion and growth by focusing on the right metrics that matter, right? By doing these things, what you're doing is you're building a better business. You're increasing the equitable value of that business because you're addressing those key value drivers of risk, right? It's an inversion-based approach. By understanding where, how an investor is looking at a business and how they're discounting a business based off of risk, by understanding how a potential buyer of a business in the future values a business in the marketplace, by understanding the other side of the table, you take an inversion-based approach and you proactively improve the drivers while you own the business. That's what we do with the equity management system, and that's why it works, right? And the byproduct becomes a business that's more sellable. It becomes a business that has higher valuations, a business that will get better terms on investment when it comes time to raise either debt or equity capital, or something quite different. Something's different, right? Which is what we've been pioneering with our performance-based capital. We want to, introduce a third type of approach to capital alignment, but that's not for this video. All right. So we're focusing on, improving the valuation of the business so that it could ultimately get exit ready, and potentially in this process, because the business is better, because the business is traversing and mastering all 5 exits of ownership, it's growing, and maybe it's actually acquiring other businesses, right? So maybe it itself becomes, Sally Sue becomes that private equity investor who's out there, finding and gobbling up other lemonade stands to improve her portfolio of companies and growing her market share and her value, right? So eventually to the point where, one day she earns the right to actually exit successfully, exit 5, and she actually goes ahead and sells, all of her businesses to another, buyer, right? Cashing out, putting the profit in her pocket, and hopefully changing her life and changing the life of her friends and family, for maybe generations to come, because this is truly a way to create life-changing wealth for many folks in a very simple way, right? Private equity at the end of the day is not a complicated thing, right? When you break it down to the basics, it's always get back to the basics. Everything starts somewhere. It's all just like the simplicity, the mastering of a basic business, right? Simple, profitable business. That's why, our advisory firm is called Simple Profits, right? If you can get back to the basics, just master the basics, the blocking and tackling. And then you look at the key drivers. You look at the why behind things. Why does a market get made? How does a market get made? It all is a matter of perspective. You change your perspective, you can then change your approach. By understanding what approach to take, you can focus, and strategy equals focus. And then that allows you to focus on the right things that are going to hopefully, impact the right levers, the value drivers that actually matter to be able to increase the overall returns in the business. And this is why folks out there with private equity can just go find a business, buy a business, and then do some simple stuff to make that business better, improve the business, improve the value of the business, and then sell the business, make a ton of money. You can do it too, right? Realistically, anybody can get into this game, as long as you master the basics and then you systematically work through it, because there's no such thing as an easy button, right? It's definitely not easy, right? Simple works, simple's not easy. It took us a long time to just get it down to the simplicity of something like master the 5 exits of ownership, right? It took us an even longer time to actually build out an equity management system that somebody can implement to build equity in a business based on the stage of ownership, of stage of exit, right? So that we can ultimately achieve these things like building wedge equity, putting more profit in our pocket, and getting to higher valuations, better terms on investment, larger exit multiples. This situation, Sally Sue was able to make it to the end, and she had a great story. Hope you do too. Trust the process, commit to the journey. Till next time.